Hello everyone, I'm Chloe. Merry Christmas and Happy New Year! Today I'll be reading the last newsletter of 2021. This is a quick review of what happened to the Bitcoin market this year, and some of the charts is useful to monitor the next bull run in 2022. For the final newsletter of the year, Glassnode will provide a brief 2021 review of some year-to-date changes across both on-chain, exchange, derivatives, and mining datasets. When looking back at 2021, it interestingly appears to be a year best described as a macro, high time frame consolidation, albeit a volatile one. The year-to-date summary for Bitcoin is: prices are up 78.5% from January 1st, with a current drawdown of 24.4% from November all-time high. The total supply currently held at a loss is 3.4 million BTC, equivalent to 18.3% of circulating supply. Exchange balances saw a net yearly outflow of 67.8 thousand BTC, a decline of just 2.5%. Long-term holders added 1.8 million BTC to their holdings, while its short-term holder supply declined by 1.5 million BTC. Futures open interest almost doubled, increasing by $9.5 billion, while its futures trading volume actually declined by 16% to $36.7 billion a day. Mining hash rate has finished 2021 up 27% on the year after recovering entirely from the Great Migration, where around 53% of miners were shut off almost overnight. Meanwhile, aggregate miner revenue is up 58% year-to-date and up over 440% since the halving event in May 2020. As the recent correction from the all-time high progressed lower, it put an increasingly large proportion of supply into an unrealized loss. Coins have been spent and redistributed through this time, which reshuffles the UTXO realized price distribution, URPD. At the time of writing, approximately 3.7 million BTC, representing 19.5% of the supply, are underwater. On a more constructive note, a reasonably large volume cluster has been established in this week's price range, equivalent to 2.2 million BTC. This indicates that a non-trivial degree of demand has been mobilized during this consolidation, with a large proportion of coins changing hands between $45,000 and $50,000. As price rallies to the top end of the consolidation range, we can see the percent of coins in an unrealized profit increase by 10.3%. We can use this to estimate an upper bound on the accumulation that has occurred lately. Similar events of large increases or decreases in profitable supply are highlighted below, which typically follow periods of relatively heavy redistribution amongst the coin supply. With respect to on-chain cohorts, there has been a noticeable redistribution in coin supply from short-term holders to long-term holders. At the time of writing, long-term holders added 1.8 million BTC to their holdings, bringing their total stack to 13.3 million BTC. This reflects an increase of 16% over the year. Short-term holder supply has declined by 1.4 million BTC, With this cohort currently holding 3 million BTC, this reflects a decline of 32% on the year. Sovereign supply, defined as all coins held outside exchange reserves, is currently at an all-time high of 13.3 million BTC. As a proportion of sovereign supply, long-term holders have seen their ownership stake increase by 4.8% to reach 74.8% of sovereign supply. To close out the year, long-term holders now own 74.8% of all coins outside of exchange reserves, while its short-term holder ownership has declined from 28% in January to 25.2% today. This modest transfer of wealth from short-term to long-term holders, despite multiple price all-time highs, suggests that 2021 is best described as market consolidation and a period of modest accumulation. Such on-chain behavior is more typically observed during bear markets, which in hindsight are effectively lengthy periods of coin redistribution from weaker hands to those with stronger and longer-term conviction. The counterpart to sovereign supply is exchange balances, which impressively have seen very little net change over the course of the year. Exchange reserves have declined from 2.6 million BTC at the start of the year to 2.5 million BTC. This is a net decline of 67.8 thousand BTC, a reduction of just 2.5% from the opening balance. The chart of coins held in exchanges shows a general oscillation over time, with net inflows from May to July and net outflows otherwise. We can see this behavior more clearly in the net volume in or out of exchanges, which has spent 2021 oscillating between plus or minus 5,000 BTC. In fact, over the course of last week, we have seen another reversal from net exchange outflows back to net exchange inflows. In the immediate term, this is something to keep an eye on to see if the trend softens or strengthens as we head to the new year. Next, we will look into the very intriguing year-to-date changes occurring in the futures markets. Total open interest in futures has almost doubled this year, rising by $9.7 billion to the total of $18.8 billion. This week alone has seen an increase of some $2.5 billion in open interest, primarily led by traders on Binance. While its futures open interest is still some way off all-time highs, rapid increases in leverage can indicate a clustering of stop losses and liquidation levels in close proximity to the current price. This adds higher probabilities to a potential short or long squeeze in the more immediate term. Alongside an elevated possibility of a leverage squeeze, we also have a general decline in trading volume. Quieter trading activity is typical towards year's end. However, on a 7-day average basis, futures market volumes have seen a year-to-date decline of 16%. Thinner volume and a rising open interest is a combination that can be favorable to at least a localized leverage squeeze over the coming weeks. And finally, we look at the mining industry to close out our review. The mining market has experienced a truly unbelievable shakeup in 2021. An estimated 53% of industry was banned from a once dominant Chinese jurisdiction in May and forced to relocate almost overnight. This was followed by a precipitous decline of 53% as miners in China were forced to cease operations and relocate or redistribute their hardware to new jurisdictions. Incredibly, the mining market has completely recovered from this enormous shift, with hash rate pushing to new all-time high at 182 exahash per second, closing out the year 27% higher. The success of this transition in the mining market is driven by the free market incentive of miner revenue, offered by the Bitcoin protocol as a reward of solving blocks. Some key statistics relating to aggregate mining revenue: $8.5 million a day following the May 2020 halving, $29.1 million a day at the start of 2021, up 242% since the halving, $46 million a day at the time of writing, up 441% since the halving, and up 58% year to date. All in all, 2021 has been a wild ride for Bitcoin investors, traders, hodlers, analysts, miners, and critics alike. The protocol saw Taproot implemented, miners relocate out of their historically dominant location, and multiple rolls of the FUD dice, landing on all sides at least twice. As is tradition, Bitcoin comes out of the year stronger and more resilient, ready to solve more blocks and create more opportunities in 2022. Thank you so much for watching. See you next time.